FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 4/2/19. We made it through April Fools, but man, there was a lot of fools out there. That's for sure. Something you can always count on. And as always, if you want to participate and be a part of the show, the email address is kl@kerrylutz.com. Well, I don't know if you like milkshakes or malteds, but there's a theory also known as the milkshake theory that goes a long way towards explaining exactly what the heck has been going on in the world all these years of massive central bank money printing and just kind of trying to basically turn back the hands of time, make the economy behave the way the economist wanted to rather than the way the market wants it to. And this has led to all sorts of malinvestment, dislocations, and somewhat confusing price movements in commodities, in gold, in silver. Somebody who's gone a long way towards clearing this up is Brent Johnson, the originator of the milkshake theory and also CEO of Santiago Capital, and first time on the show. And Brett, it's great to have you on. So looking at your theory of the world, because that's what the milkshake theory really comes down to. How does it work? What is this milkshake and how do we get rid of it?
Good. Yeah. Happy to go into that. Thanks. Before we get started, thanks for having me on. I've listened to you for a number of years and appreciate what you do. So I'm excited to get a chance to talk to you and your listeners. Essentially, for those who have not heard the milkshake theory before, is my belief that over the last 10 years, the central banks have flooded the market with liquidity. Now, whether you think that's enough or not enough, and whether you think that's inflationary or deflationary, let's just set that aside for now. It doesn't change the fact that, subsequent to the global financial crisis, the central banks of the world opened the floodgates, didn't physically print money, but they, went through QE programs, expanded the liquidity and the central bank balance sheets by, let's just call it $20 trillion. Mm-hmm. And with, today's markets, 100 years ago or 200 years ago, if a central bank did this or if a monetary authority did this, the likelihood of that liquidity just staying in that domestic economy was probably pretty high. But in today's, globalization world, for lack of a better word, or global world order, wherever the capital is printed, it doesn't necessarily stay that. So capital that's injected in Tokyo can wind up in Frankfurt, and liquidity that's injected in Frankfurt can wind up in Texas. And it's really a global network. And so as the central banks have created, I call it this monetary milkshake, because they've just flooded, the markets with liquidity, yen, yuan, dollars, pounds, euros, et cetera, et cetera. It's just kind of this big soup or milkshake, as I call it. And over the last couple of years, based on policies that have been implemented in the United States, as well as policies that have been implemented abroad, both in Asia and Europe, it makes capital more attracted, in my opinion, to the U.S. markets than to the rest of the world. Part of that has to do with regulatory effects that Europe has put into place. Some of it has to do with capital controls that China's put into place. A lot of it has to do with U.S. monetary policy, as far as our rates being higher than everyone else. And then just the Trump trade policies have a big, huge fiscal impact and a big impact on capital flow. And I think the combination of all that leads to the U.S. sucking up the rest of the world's milkshake that the rest of the world has, quote unquote, printed, for lack of a better word. And I think that capital comes into the U.S. not because we're in good shape. I think we're actually in bad shape. But I think we're in better shape than most everybody else, if not everybody else. And so on a relative basis, and I know people get tired of this clean as dirty shirt, analogy, but I think it's largely correct. And I think on a relative basis, we look a lot better than everywhere else. I think the capital gets pulled into the U.S. markets. I think that pushes the dollar higher. And somewhat counterintuitively, I think that pushes U.S. assets higher as well. That happening, the dollar getting stronger, actually kind of creates this vicious knock-on effect where it makes the dollar get even stronger, because a strong dollar puts enormous pressure on the rest of the world. And as the rest of the world comes under pressure and their markets break down, I think that leads to even more capital coming into the dollar, not just because of our higher rates or better, policy, treatment of capital. But then we start to get a flight to safety flow of capital. And I just think that we get into a period where the dollar gets much stronger, the rest of the world gets much weaker, and it's eventually all going to end very, very, very badly. I just don't think it's going to end yet.
Yeah. And obviously, the economy is not that great. We're still nowhere near in housing where we were in 2007. There's so many indicators. And of course, unemployment, well, they've changed all of the definitions of unemployment. So certainly U1 is nowhere, it's a different measure than it was 10 years ago for sure. And when we look at all of these things that have happened, so also, I guess you could add to the milkshake the fact that before the milkshake experiment, if you will, there was a big short on the dollar where everyone was borrowing long on the dollar because they expected it to go down. And of course, the market, in its infinite wisdom, always frustrates the majority of players. Now they're forced to pay back dollar borrowings in a diminished local currency vis-a-vis the dollar. So this has compounded the thing, hasn't it?
Yeah, and that's a very big part of it. I talk to people all the time about the U.S. debt. Listen, I think the U.S. debt is a huge problem. I do not think that the fact that we have such an enormous amount of on-balance sheet debt, forget about the off-channel balance sheet debt, just the on-balance sheet debt is ridiculous, for lack of a better word, right? And there's going to be a huge price to pay for that. But what people forget is that, so if the U.S. has $20 trillion of on-balance sheet debt, the rest of the world has $10 trillion of U.S. dollar denominated debt. So, for the rest of the world to have $10 trillion in dollar denominated debt, which is not their own currency, which they can't print and which is getting stronger rather than weaker, it kind of leads to this, big knock-on effect that I was talking about earlier. And I always talk about, it's the key to all of this is the debt. And the reality is, until all the debt is repudiated, and that actually has a negative consequence as well, which we can talk about if you want, but until the debt is repudiated, dollar-based debt is demand for dollars. If you just take the interest payments alone to fund all the dollar-based debt in the world, it's almost $1 trillion a year just to pay the interest. And, a big portion of that it has to be paid by entities overseas where it's not their home currency. That's a huge, huge problem, because if you can't pay the debt, then it starts this daisy chain effect where everything kind of all the debt kind of implodes on each other, on itself, I should say, and you get into a 2008 type scenario. So the dollar-based debt is a huge, huge driver of the whole theory, for lack of a better word.
Yeah, and so this has forced these companies to bring operations to the U.S. so they can earn profits in U.S. dollars, right? So it's really had a perverse effect.
Yeah, I mean, and that's why a lot of people tell me that, foreign direct investment in the U.S. is falling, but the reality is it's not. Some of our biggest competitors are moving operations here because they get treated better from a regulatory perspective, they get treated better from a tax perspective, and they get to earn in dollars, which helps them pay their dollar debt. Again, this whole thing is not that the U.S. is doing well and that we are some, good stewards of financial capital. I don't believe that that's the case. Yeah. I just believe that based on the way the system is designed and the way it's currently operating, that we're going to get a short squeeze on the dollar, which pushes the dollar much higher. And you can say it, we don't deserve it. I agree with you. If you say, I don't think that this is a moral outcome. I don't think that this is I don't think this is justice being served. I just think it's what's going to happen.
Yeah, well, reality is reality. You can have your own opinion, but you can't have your own facts, as some wise politician once said, right? And
it's hard to keep those straight these days.
Yeah. So, and the other thing is, if you're a big European money manager or you're a big European corporation, are you going to put your money over the weekend in Deutsche Bank or in the Chinese Industrial Development Bank or whatever bank is out, the Bank of China, not the central bank. You're going to leave it there for the weekend, or are you going to throw it in JP Morgan, where you have like probably less risk? And that's what they're doing, right? That's
exactly right. And, I get into this exact conversation a lot, most often with people kind of in the gold community. And listen, I want to say up front, I am a huge, huge advocate for gold. I think everybody should have gold in their portfolio, if for no other reason than just pure insurance reasons. So this is not me talking bad about gold. I love everybody in the gold community. I think they are among the most hardest working and well-intentioned people, I've ever met. I do think that they get this a little bit wrong, though, and that I think that a lot of times when they look at this issue, they look at it from their perspective. Gold is a little bit, to a certain extent, like a religion. Like once you kind of get it, you kind of understand it, right? And once you get it, it's hard not to get it anymore. It's hard not to see it anymore. And so when they look at these issues, they're thinking of it from their perspective, knowing what they know about the monetary system, knowing what they know about the positive aspects of gold and what a great role gold could play in the world. And so then when they try to put themselves in somebody else's shoes, they will look at it from another perspective, but they're still thinking like themselves. And I think what they need to do is they need to not only sit in that other guy's seat or that other lady's seat, but they need to think how that person thinks. And the reality is most people in the world don't care about gold, or I should say most people in the Western markets, right? Now, people tell me all the time, people in China and Asia have a big affinity for gold, and I agree. So maybe they get it a little bit more than the rest of the world. But, to your point, a pension fund manager or a big mutual fund manager, sitting in London or Frankfurt or wherever it is, has a choice of where they're going to put their money. They don't really have the choice to put 70% of their money or even 7% of their money into gold. It just, they don't really have that option. Now, things might happen in the future that allows that to happen, but right now, it's not even on their radar to that level. And so even if you think they're going to put 1 or 2% of their money in gold, they've still got 98% of their portfolio that's got to go somewhere else. And I think the rest of that, big portion of the portfolio is going to get allocated towards dollars and dollar U.S. institutions rather than Chinese institutions in the yuan or Japanese institutions in the yen or European institutions in the euro. I just think that's how it's set up. Now, that'll change someday. I just don't think we're there yet.
Well, so let's look at China. In the U.S.'s heyday, let's agree that it was during the robber baron era, the so-called robber baron era, the Carnegies, the Rockefellers, none of them were sending their money overseas and buying places overseas only as like a hobby, like Carnegie in Scotland. But they were committed to here. There was no place they were going to go. The Chinese, it's the exact opposite. They can't wait to get the hell out of the place. Yeah. And that, to me, casts doubt on the so-called Chinese ascendancy. It might well happen. I'm not doubting that they're rising. But when your own people flee and you have this huge flight capital issue, what does that say about your economic model, your rule of law, your whole lifestyle of the country, everything else? People are fleeing, your most successful citizens.
Yeah, I'm right there with you. I think, part of the problem and part of, you can look at it as a problem or however you want to look at it, but one of the key attributes here is the lack of a good alternative to the dollar. Now, I know, again, people will tell me that gold is a good alternative. Now, I happen to agree with you that gold is a good alternative, but I also happen to think that the rest of the world doesn't agree with us, and it's highly unlikely that they are going to willfully institute a system in which gold is the primary, beneficiary. I'm not saying it won't happen. The markets might force them to do that at some point, but I just don't think that we're there yet. And a big part of it is what you just talked about with China. Is China ascending? Yeah, of course they are. But China has huge problems. When you look at the fiscal imbalances that we have and the fiscal improprieties that we've done and the amount of dollars that we've borrowed and you can argue how much GDP is just due to the debt that we've taken on. Well, you put all those same things on China and it's even worse. I mean, they've printed more and they've extended more credit in the last 40 years than we did in 200. So, you can't, it kind of drives me crazy when people talk about the fiscal improprieties of the United States and then hold China up as this shining example. It's just, to me, it's a huge cognitive dissonance issue that for whatever reason, they just can't see past.
And when we're talking about all these problems, there's no political solution to them, right? It has to be extra political because there's too much money. Yep. We got too much debt. So something has to give at some point. I don't know whether it's a debt jubilee or massive defaults. Historically, government debt has not been the place to be if you're looking for safety of your capital.
FSN Radio. It's all about what's next.
Egypt is on the verge, once again, becoming a world-renowned gold producer. The Golden Age is being rediscovered. For millennia, ancient Egyptian kingdoms prospered from unparalleled riches. Pharaohs built their empires and flaunted their abundant wealth that was made possible by the country's resource-rich gold deposits. Despite this rich history, modern Egypt remains one of the most underdeveloped gold mining countries in the world. Oren Resources is at the center of the modern Egyptian mining world, diligently working both as the only public exploration company in Egypt today and as the advocate for mining reform with the Egyptian government. However, those that arrive early like Oren will reap the best rewards. Oren's discovery of the legendary Lost Mountain of Gold at Rhodes and its current aggressive drilling program there could potentially reap those rewards. Oren Resources is focused on its 100% owned Abu Marawat concession in the Arabian-Nubian Shield, located 200 kilometers north of Centamin Sakari's world-class gold mine. Oren possesses first-mover advantage in the underfollowed jurisdiction of Egypt, which is currently undergoing mining reform. To stay on top of Oren's latest drill results and news, go to AtonResources.com. Oren trades on the Toronto Venture Exchange under the ticker AAN and on the OTC under the ticker ANLBF.
The Financial Survival Network. It's all about what's next.
That's right. So I think that we will eventually get to a situation where much of the debt is forgiven. Maybe it's just the bonds that are sitting on the central bank balance sheets. Here's the problem with a debt jubilee is that if you remove that much of the underlying collateral, you have to understand that the way the monetary system is designed is that a lot of sovereign credit is used to then extend more credit into the system. So if that sovereign credit gets removed, the collateral for the whole system gets removed. And so then you have huge, that has a huge impact on the supply of money available. And so it's not quite as easy as just saying that we're going to repudiate the debt or we're going to forgive the debt, right? And so it really does become this big spider web of interlinked, monetary systems. And so I do think that in some form or another, the debts are just too big. They're going to have to be removed or written off or defaulted on in some form, right? The math just doesn't work any other way. I don't know if we're quite there yet or not, but I think this is important to point out. One thing that people will often say to me when we're discussing this is they'll say, yeah, Brent, what if all these foreign entities, what if they just don't pay their dollar debt? And I say, okay, let's think through this. So let's say they owe, I don't know, $1 trillion. There's $10 trillion of US dollar debt out there that's owned by foreign entities. Let's just take 1 trillion as an example. Let's say somebody owes 1 trillion and they just say, you know what, we're not paying it. Okay, so now all of a sudden that debt is gone. But in today's economy, debt is money. Like debt is the basis of which credit is extended. So all of a sudden you take out that collateral. Now all these other loans that it was collateralized against you're actually removing money from the system. So the supply, when debt gets written off or when debt dies or when debt is defaulted on, it's gone. And so that creates that daisy chain of other defaults similar to what we had in 2008. And in that scenario, the supply of money falls. And so even if the demand for dollars falls because the debt has been defaulted on, if supply falls even faster, you still have a rising dollar because the supply is shrinking at an exponential rate compared to the demand. So, you still get a rising dollar and it leads to even more problems. So the idea of just skipping out on the debt or defaulting on the debt or repudiating the debt or a debt jubilee, it's not quite as simple as just saying it. And I think that gets back into theory versus practice, or theory versus real world. And I think the central banks are guilty of that as much as anybody. It works on their model in the Fed building, but it doesn't work in the real world. And I think that also goes with, this repudiation or the defaulting on the debt. Yeah, it sounds perfect, right? You just don't pay it and everything's fine. Well, it doesn't, in the real world, it doesn't work like that. And so I think listen, it's a big convoluted mess. And I certainly am not going to sit here and say that I understand it perfectly. I don't think anybody understands it perfectly. But all of my research just leads me to believe that this ends in a dollar going much higher. And I think that has enormous knock-on effects for the rest of the world.
And just because the dollar is going higher doesn't mean that gold can't be going higher as well, because
absolutely,
it could well be.
In my opinion. So I grew up playing basketball, and in college I played basketball. And my coach in college used to always say he'd go to war with man-to-man defense and passing game offense. He said, if you don't need to know anything else, we'll just know those two things. And based on the years ahead, I think the two most important things are dollars and gold. If I had to go to war with just dollars and gold, I think I'd win every time, because I think those are going to be the last two men standing. But I think eventually gold is going to win the day, and I think the dollar will fall against gold. But I think initially the dollar will go up first. I think they will both rise together. And then I think that gold will go through the roof and the dollar will eventually fall. I just don't think we're there yet. And I kind of wish we were. I mean, I thought we would be there sooner than we are.
Suspense is killing us, right?
Right. And I got the timing wrong.
Me too.
I've said that publicly before. And, back in 2012 and 13 and 14, I was a big advocate for gold and thinking, and I'm still a big advocate. I'm just not as convinced now that the price is going to spike as I did back in 13 and 14 and 15. I do think it still will, and I think it'll probably go even higher than I initially thought. I just don't think it's going to happen as quickly as I initially thought it was going to, because based on the things that have changed in the last 2 or 3 years, once I kind of figured out this whole dollar situation, I realized that, the idea that the dollar was just going to go to zero wasn't quite as simple as it sounds when you read it in a newsletter or something. There's no doubt that the central banks will have to come in and do something, but I just don't know that, I'm just not convinced the Fed's going to come in and just print to oblivion right now. I think it's going to go much differently than that.
Yeah, and what we're talking about really explains why we didn't have hyperinflation in the United States with all that money printing.
Absolutely.
Because money was,
what's interesting now, Kerry, is I find this kind of fascinating, because for the last 10 years, a lot of people, and listen, I do it too. This is not to be a negative statement towards anybody else, but a lot of people have talked about all the money that's been printed. In reality, the money wasn't printed. Money was loaned to the banks and it sat on the bank's balance sheet. What I find interesting now is, because that did not lead to inflation, people are starting to question the efficiency or the efficacy, however you want to say it, of the central banks. And that's why this MMT movement is picking up. Right. This is central bank policy on steroids to a certain extent. This is where they will actually really physically print the money, not just give it to the banks and see what the banks do with it. Helicopter. I mean, this is the money from the helicopters. This is, fiscal budgets that have around $3 trillion deficits. This is, just printing whatever money we need. The government can never, technically be in a deficit because they can just print whatever they need. I mean, these policies are coming to the fore because of populist movements and because of, to a certain extent, failure of the policies of the Fed. And I think this actually scares the hell out of the Fed, because the Fed, I think, feels like they're under attack because the monetary policy may be taken away from them and given back to the politicians, which, we both know how that's going to end, right?
Hey, maybe we could call this the cheap tequila theory of monetary expansion,
right.
Because,
exactly.
Tequila, it sounds good, but then nothing worse than cheap tequila, nothing worse than cheap money.
Wake up the next morning and things didn't work out the way you thought.
Yeah, if you wake up. So we got some interesting times ahead, and we got no way out of this. But I don't know. I always joke maybe we could sell. The federal government owns half of California, and it's not really doing anybody any good other than the military bases, maybe. So if they just were to sell off half the state of California, that could get rid of the debt and future debt for quite a while, couldn't it?
Yeah, I live out here in California, and I've lived here for almost 20 years, and I've only ever felt one or two kind of small earthquakes. So we're going to have that big earthquake at some point. Maybe it'll be like that Superman movie where we just fall off into the ocean, save everybody a lot of trouble.
Yeah, well, you're on the left coast, that's for sure. So, and that's content for another story for sure, because the deterioration of your state there is just breathtaking. I can't even believe it. But
yeah, I have kind of this love-hate relationship with California, because it is an amazing state just from a geographic and nature standpoint, and there's a lot of interesting people. Some of them I like, some of them I don't, but you always meet interesting people.
Yes.
But you can go skiing or surfing or hiking, or you go to the vineyards, or you go to the desert, and you go to the ocean. It's an amazing place, but the policies and the budget and the politicians, they tend to drive me a little bit crazy.
Oh, you're not the only one, for sure. You're not the only one, but no. But hey, so what's the Fed's next move? They've already said there are no more interest rate increases for the rest of the year. They're going to start cutting?
I'm in the opinion that they're not going to cut. And the reason I say they're not, I don't think they're going to have to. And this is probably the part of my theory or whatever that gets the most pushback, is that I think that once, however you want to, I just think there's going to be this crisis, right? And I think it's primarily going to be a sovereign debt crisis / currency crisis. And I think when that happens, that the U.S. is going to get capital flows, as I've mentioned before. And I'm of the belief that those capital flows are going to a certain extent, blunt. And I'm not going to say that we've decoupled from the rest of the world. I just don't believe that. But I think that the capital flows into the dollar may provide some liquidity to us that the rest of the world suffers from. And that may allow the Fed to keep from cutting rates. I'm not sure. We'll see. I think whatever happens, that our rates stay higher than the rest of the world. And I think that we'll still get this inflow of capital. But I'm not convinced they're going to cut. I know they've kind of said that they're not going to raise anymore. And I know the market's kind of betting on a cut. And, it's been a huge 360 or I guess 180 from December. But I think I have a bet out there with Peter Schiff or something that, I said the next move will be a raise, and he said the next move will be a cut. So I'll stand by that.
Yeah, well, I'm kind of inclined to think nominal rate cuts, not going to be a bandwagon effect, but just to reassure the market, keep the stock market going higher. That's the other thing. Stock market, Martin Armstrong, I'm sure you followed him. He said from the get-go, I've been interviewing him since I started this 8 years ago, that the stock market was going to keep on going higher. And he's predicting 42,000 on the Dow, 50-something thousand. And everybody has laughed at this guy. And yet he has been right on the money.
I came across Martin in 2008 or 2009. I can't remember when, but it was during the kind of the crisis. And he was writing his letters from jail. And mailing, writing them on a typewriter and mailing them out. And, I started reading this guy and I was like, God, this guy's so smart. I didn't agree with him, but I just thought his stuff was just so interesting and he came at things a different way. And, so I've been reading him for a long time, and I have to give him credit for opening my eyes to this possibility. There's some things that we disagree on. And listen, I'm not putting on myself on the same level as Martin Armstrong. But, I do think that he is, for me, he's been a big help as far as just stepping back, saying, maybe I don't have this exactly right. How could the opposite thing happen? And if that did happen, what would lead to that happening? So he to a certain extent opened my eyes to at least, keeping an open mind to the possibility. I'm not sure if we see things exactly the same as far as rates, but I certainly am on board with him regarding the dollar and the capital flows. Where it goes from there, I'm not sure.
Yeah. Yep, for sure. And it's all been an issue of capital flows that have enabled the market to go up. I think people are looking for tangible assets. Yeah. And if you can't buy gold, you could buy a gold stock, or that sector is done really well below the norm. But you can find stocks that aren't super out of whack as far as PE, if they even look at that now, or valuation. and foreign companies have been buying them, and you have liquidity. Really, stocks are like cash now too, aren't they?
Yeah. Yeah. I mean, that's the thing is, so you think about the stock market, and let's say that even if you subscribe to the idea that the U.S. is tapped out, the U.S. is not going to put any more money into the stock market. But let's say that you do agree with me that the dollar is going to get higher. Well, if the dollar is going to go higher, that means that the yen, the euro, the yuan, the pound, they're getting weaker, right? And so for those countries, buying the Dow, even if the Dow doesn't go anywhere, if their currencies go down 10%, they've just made 10%. Right. Mm-hmm. So I think, that you kind of have to look at it from the whole world perspective and not just from the U.S. perspective and say the U.S., the U.S. consumer or the U.S. investor are tapped out. Well, you know what? There's a whole other world out there that can access our markets and that want to access our markets. And if they can buy a U.S. blue chip company that pays a 2 or 3% dividend and their currency goes down 5 or 6 or 8%, all of a sudden they made a double-digit return for the year. That's not bad in this environment.
Yeah, you win by losing, and right? Isn't that?
I mean, the whole world's upside down, right?
Yeah, because it used to be you had to win because you were smarter. Here, all you have to do is bet on the ultimate failure of your country's monetary policy and the less relative failure of the U.S. for now. And let's face it, portfolio managers, all these investment types, they live from quarter to quarter. They don't really care about 3 years from now when everything goes to hell in a handbasket.
That's right. It's a relative world. I tell people that all the time. From a capital allocation standpoint, it's a relative world. It'll all blow up on an absolute basis at some point. And so, you need to own some gold. But until then, it is a relative world.
Yes, very true. And I got to tell you, the belief that the Chinese are so fully invested in gold, maybe the central government is hoarding it. Maybe super wealthy, more international type citizens are buying gold. But all I can tell you from my experience, I met a guy in upper middle class Chinese. He was a trade company guy. And, he had $100,000 car. I don't know if he paid cash for it or not. Used to be they had to pay cash for everything. But I said, so you buying gold? And he looked at me like I fell off a rock somewhere. Like, what? Like real estate's where it's at. That's what he told me. And I said, but I thought your government was telling you to buy gold. And it's like, no, real estate, that's the future. And so he was very provincial and, kind of a little naive in his outlook. And, it just showed me that, hey, you can't always believe everything that you read,
Right.
So, well, we got to give it up here. But Brent, it's really been fun having you on. Really brought some clarity to this debate. And it makes a lot of sense, especially when you look at it in light of what we've been through over the past several years. And it just makes total sense when you think about it, right?
Yeah, I think so. I think the next 2 or 3 years are going to be pretty interesting, obviously. That old saying, may you live in interesting times. Well, I think we're going to get it.
Yeah, that's a curse, a Chinese curse, and I think we're getting it. Hey, where's the best place to find your work? I mean, your website doesn't give me much. Where do I go?
Well, you can email me, Brent at SantiagoCapital.com. I have just a landing page at SantiagoCapital.com. You can follow me on Twitter, which is at Santiago AU Fund. I'm pretty active there, but, I'm happy to come back, happy to, do this again at some point. And if any of your listeners have any questions, feel free to reach out to me directly.
Yeah. And hey, by the way, the person who recommended you, if you are listening now, thank you. I don't remember who you were and I have to look through my emails. Great addition to our line of experts. By now you've heard, we've interviewed thousands of people, and the number of people who really understand what's going on, it's a very small number, probably could count them all on my fingers and toes. Fortunately, Brent, you are one of them. Really appreciate you coming on. Any questions or comments for Brent? You should have some. Just email us, kl@kerrylutz.com, Twitter feed at Kerry Lutz, Facebook page, Financial Survival Network. I don't know what's going on out there in YouTube land, but thousands of you are listening to every single episode. So please subscribe, like, and share. And if you're listening on a podcast, do the same. It really helps me a lot when you do it. It really helps get ideas such as Brent's out there to the people who can most profit from them. And hopefully they'll listen soon. Brent, thank you so much for coming on. It's been an absolute pleasure.
Absolutely. Have a great day.
The Financial Survival Network. It's all about what's next.
Today's show is brought to you by Blue Sky Uranium Corporation. Blue Sky has first mover advantage in Argentina in the world's newest uranium and vanadium district. With an existing near-surface deposit that's open for expansion, Blue Sky also controls a massive district-scale land package with mineralization along a 145-kilometer-long trend. Blue Sky possesses tremendous exploration upside and is an excellent leverage play on rising uranium and vanadium prices. The company is run by a best-in-class management and technical team with proven exploration and development success in Argentina. Blue Sky Uranium trades under the ticker symbol BSK on the Toronto Venture Exchange and as BKUCF on the OTC. For more information and to stay on top of the latest news, go to blueskyuranium.com. That's blueskyuranium.com.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's April Fool's Day. That's right, 4/1/19. And well, hey, biggest joke? Gold is down. Actually, that's not a joke. It's down $2.20 the ounce. They beat it up pretty good, so it closed below $1,300 for March. Is that painting the tape, or is that what gold is really worth? Well, you'll have to decide that. But when you do, email us, kl@kerrylutz.com. Let us know what you think. We're going to take some of your questions today. Jon Rubino is on with us now. Jon, happy Monday. So good news is now good news, and bad news is now good news, at least as far as the stock markets are concerned. Is that a pattern?
Well, it's logical given what's going on in the world now, Kerry, because if you look at the kind of sea change that has happened in central bank policy over the last few months, they've gone from being tightening in the case of the U.S. to promising to tighten in the case of most of the other big central banks, but some bad financial and economic numbers convinced them otherwise over the last couple of months. And now the European Central Bank and the Bank of Japan are back to kind of aggressively easing, and the U.S. has stopped tightening, and everybody's waiting for the first rate cut from the Fed. That's what the markets now see as the next move on our part, which would bring all the central banks back into line. We'd have coordinated global easing, which is good for financial asset prices because all that new money they're dumping into the system has to go somewhere, and frequently it goes into equities. So this past week, a lot of pretty bad economic numbers have come out in the U.S. And normally and logically, that would be bad for stock prices because it points to lower corporate earnings. But the markets now are interpreting bad news as good news because it means the Fed's going to have to cut rates pretty soon. Just to give you a few examples of what happened, just 3 store chains, JCPenney, Payless, and something called Lifeway, which I'm not familiar with, are going to close.
Life support. It should be called Life Support, but yeah.
Well, they're going to close 3,000 stores this year in the U.S., that's a lot of stores just from 3 chains. Germany now is in a manufacturing recession. In other words, their manufacturing output has been falling for several months in a row. The Eurozone factory activity in general is contracting, and the contraction is accelerating. And U.S. retail sales just this morning surprised to the downside. In other words, it was unexpectedly weak. So you put all that together and you get a picture of a slowing global economy and lower corporate profits. So if the markets weren't expecting central banks to react pretty aggressively to this, it would be really bad news for stock prices. But it's the opposite today because, or it's the opposite over the last really month because stocks have been rocketing because we expect easing. And I think we'll get it. I think by mid-year, the Fed is going to be softening us up for the next rate cut, and then it'll come sometime after that. Although, the timing is impossible to predict. I'm just throwing that out there. But
absolutely. Well, here's a question. That's a
big change in the world.
Here's a question from Jesse, long-time FSN community member and active, although it hasn't been that active lately, sending emails. So what a difference a week can make. This came in a while ago. The unknowns are obvious. The T-bond market has inverted, signaling the start of a blank storm. And the Fed has what tools? Bet we will find that answer out fairly soon. For Jon, what does the drop in rates, negative in Germany again, mean for Deutsche Bank revenue? How might this affect their liquidity, solvency, stock valuation? We haven't talked about that, but Deutsche Bank said that they need to raise 10 billion euros in equity. And who's going to buy this except the German government? Because the German government is not going to let it go down the tubes. So as he said, I can only imagine the topics in the coming weeks. Far, far too many to cover in a podcast. All the best, Jesse. So where are we here, Jon? I mean, part of that question has already been answered, but what's going to happen with this? Well,
the inverting yield curve is actually the biggest piece of bad news that I probably should have mentioned with the smaller pieces just now, because that is it's something that precedes recessions, generally speaking. When the yield curve inverts, you get a recession within the next year. Whether it's causality or coincidence is open for debate, but they happen together generally, and the yield curve inversion usually comes first. So that's a piece of very bad news from the standpoint of corporate profits and usually stock prices. But again, it's a piece of good news from the point of view of what's the Fed going to do next, because it increases the odds that they cut rates. Because if they cut short rates dramatically, then the yield curve isn't inverted anymore. So they can solve that issue at the short end of the spectrum. Now, Deutsche Bank is a massive global bank, incredibly badly managed in the last few years, but too big to fail. So what do you do if you're Europe? You, I guess in this case, try to combine them with Commerce Bank, which is not quite as badly run, and then figure you can generate a lot of efficiencies by eliminating duplication in management and in product lines, et cetera, and hope that the resulting entity is healthy. Now, as you said, who would be buying the equity that Deutsche Bank has to issue in order to bring its finances in line with Commerce Banks? In other words, to make in effect, an acquisition of Deutsche by Commerce Bank reasonable. It kind of has to be the governments, especially the German government, because buying equity in a clearly failed institution isn't a logical thing to do if you're a normal stock investor. If you're a vulture and you're looking for busted assets, maybe it's a good deal. But $10 billion is a lot of vulture money. So, but it's the same thing with failed entities around the world. I just posted a thing on Dollar Collapse titled, "Who in their right mind would lend money to Chicago?" Because Chicago and Illinois and Illinois they're issuing a lot of debt in the last few years, or in the coming year, and somebody has to buy those bonds, right? And they are either junk bond rated in the case of Chicago.
On a good day, they're junk.
One notch above junk in the case of Illinois. So you got to be pretty optimistic about the world to be lending money to entities like this, unless you think you're really lending money to the federal government, because the federal government is going to have to step in and bail these guys out. And it's the same thing in Europe with, for instance, Italy. When Italy issues bonds, anybody who buys them who isn't the European Central Bank is basically betting that they're really buying German bonds, because Germany is going to have to bail out Italy via the European Central Bank. So there's stuff like this going on all over the world where people are buying really crappy paper, which looks like an illogical move, But their second level bet is that crappy paper will be taken over by a non-crappy borrower, like the European Central Bank or the U.S. Fed or the U.S. government, and so they'll actually make out by buying junk that is then converted into high-grade paper at some point. Now, this is really the definition of moral hazard, right? It's encouraging all these failed entities to keep borrowing money because people are willing to buy the debt that they're issuing or the equity that they're issuing because they assume a bailout, and so the bad behavior doesn't stop because it doesn't have to stop.
Mm-hmm. Yes. And you really can't be too surprised about this, right? I mean,
well, no, we've been doing this for decades.
Yeah, it's crazy.
Yeah, well, but the result of that is that you have this huge accumulation of debt in the center. In other words, the strong entities are seeing their debt soar or their obligations soar as they give guarantees if they don't actually take on the debt itself. So the formerly AAA rated credits like the U.S. and Germany really aren't high grade credits anymore. Their debts are rising so much faster than their ability to create wealth to pay off that debt that you can't look at them as pristine credits anymore, even though they're still rated that way. And at some point, that's going to be one of the big changes in the global financial system when recognition hits that, a bailout by the U.S. of some sector of the U.S. economy isn't a good thing anymore because it's piling so much debt onto taxpayers that the taxpayers are now heading for junk status at an accelerating rate. It all comes back to the currency markets at that point because the governments of the world can keep playing these games as long as they got currencies that they can issue that people consider to be of value. But once the value of the major currencies start falling, which is to say once prices of real things start going up dramatically, then it's game over. So we're seeing the game be played. We understand the inherent dysfunction in all of it, but the end game hasn't come yet. The final chapter hasn't been written. The final inning hasn't been played. But that's coming based on the amount of really crappy paper that's going to have to be bailed out at some point soon. Italy is the second biggest debtor in the Eurozone. Deutsche Bank is a gigantic bank. It's one of the top 5 banks in the world in terms of assets.
Huge.
And I think the derivative book might be the biggest derivatives book of any, So we're talking major entities here that have to be bailed out. And then, then you've got Illinois and Chicago and California's pension system and New Jersey's pension system and a lot of the other Eurozone countries that are in almost as bad a shape as Italy, and banking systems that are in almost as bad a shape as Deutsche Bank. It goes on. And once it starts, where does it stop? Failed entities that line up for a bailout are just going to be amazing. And, I do think that at some point, people realize that the currencies that are being used for all these bailouts really aren't worth anything either. And then, game over.
Yeah, when are they going to realize that? Hey, we got one other question. Actually, we have a lot more, but this one I felt was really interesting. I'll read it. You give your opinion. I'll give mine. Here it is from Bart. I have never heard this question addressed. Is the U.S. accumulating gold? We hear about many of the other nations of the world buying gold. What about the U.S.? And you give your opinion. I'll give mine, John.
Well, the U.S. doesn't tell us. And that's a big bone of contention in the sound money community, because a lot of people look at the amount of gold that's being imported by the gold accumulators, China and India and Russia, and see that equals or exceeds the amount of gold that's being produced by gold mines all around the world, which means there's nothing left for anybody else who's buying gold unless some secret source of gold
there is scrap, but not what there once was. obviously.
Yeah.
During 2010, 2011, cash for gold and all that was out of control. It was off the chain. But now, not so much.
Well, you look at what's being imported by, for instance, China. They don't announce a real number for their official gold reserves, but what's being imported is immense. So where's it going and where's it coming from? And see, that's the question. And a lot of people in the sound money community think that it's coming from the UK and the US. In other words, Western powers are sending their gold to the East in return for basically cheap manufactured junk that the East is sending us. And because nobody's telling us this stuff, we're left to speculate. And I don't know. I don't know if the U.S. is accumulating gold. That would be the smart thing to do. But how many times recently have we done
anything smart?
Yeah.
When was the last time we did anything smart?
You want to hear about a smart thing? Yeah. Russia just announced that its foreign exchange reserves, in other words, it's government bonds, no U.S. government bonds. They've gotten rid of them, but government bonds and gold now equal its debts, its government debts, which is the definition of a fairly strong monetary system. No other big country can say anything remotely like that.
No, definitely not.
So Russia is running its monetary system in a way that seems wise from a sound money perspective.
A classical economic perspective. It makes a lot of sense. In today's world, people are scratching their heads and wondering, well, why would they do such a thing?
Why would Russia do such a thing?
It makes no sense from modern economic monetary theory. It's like you should be putting that money to work. You shouldn't be burying it in the ground and forgetting about it where it plays absolutely no use whatsoever. Are you crazy? Right?
Yeah, the way to wealth in the modern world is to borrow a lot of money and then put it to work, as you said, rather than accumulating a lot of reserves against hard times in the future. So, it's kind of the grasshopper versus the ant thing. And the ant wins in the end. Spoiler alert.
Yeah, or the tortoise and the hare, right?
Yeah.
Same thing.
Yeah.
Or the
slow and steady and safety.
Yeah, or the
are the ways you win in the long run.
Yeah, or the golfer against the alligator. If you piss off that alligator enough,
sounds like the alligator wins.
Well, it's like the alligator swallows the golfer's ball, and the golfer comes over with his driver and proceeds to start whacking the alligator to get his ball back. And of course,
I get that because otherwise he loses a stroke.
Yeah, exactly. So instead he loses an arm instead of a stroke because the alligator eventually is going to get pissed off and take off his arm. Talking about gators, up by me in Jupiter, just a little further north of me, in a park that I've been to many a time, they found a gator that was 12 feet long and 750 pounds. And he was just hanging out there minding his own business. But of course, his business in the middle of a public park with kids, there's baseball diamonds there. There's all sorts of recreational activities going on. He had to go. And they came and an old gator like that, they generally are not going to kill. The only time they kill them is when they're not scared of humans, which most of them are. And instead they go put a band around his snout so he can't use his mouth, and then they use a forklift or something to load him into the back of a truck, and then they take him out to the wilderness, wherever that is, cut the thing off his mouth and dump him and run like hell.
Well, you Floridians are tough.
Oh God, you can't make this stuff up, John. You just can't make it up. But the gator and the golfer, I think, eventually what happens to all golfers is they get old, they can't play, they can't walk, they can't even take the cart anymore, and then they die. So, but the gator goes on as long as he doesn't get in the wrong place at the wrong time and get taken out by a hunter or whatever, then he's okay. So I would say Putin's more like the gator than the golfer.
Okay. Okay, that makes sense.
That's
that original. The popular perception of Putin, that he's a dangerous guy.
Oh, he is.
And you need to be super careful. Yeah,
he is. And, what else are you going to do? It's too far down the rabbit hole. Maybe Russia will be left standing, but then again, their main export is oil and natural gas, and that is diminishing, and it's a poorly diversified economy, and maybe they will be the winner. Maybe they'll just be less of a loser when the transition takes place.
Gary, remember a while ago, though, I said something like that. I badmouthed Russia's economy. And one of your listeners wrote in about how that was true a few years ago, but it wasn't true anymore. Their demographics have improved. Their population isn't crashing anymore, and they actually had diversified their economy so that they export a lot of stuff. They're big agricultural exporters now.
Yeah, I mean it's a look, but oil far and away disproportionately large share of their exports. And look, if it gets as bad as it could get, we could see amazingly sharp reductions in consumption of petrochemicals and petroleum. It could happen. The electric thing's got a ways to go before it really makes an impact on gasoline and diesel consumption, but a bad economy can be way more injurious than, a transition to another energy source.
But, for instance, compare Russia and Saudi Arabia, the two big oil exporters. Saudi Arabia, it sells its oil, and then it divides up all the proceeds between 10,000 inbred idiot princes who then come over here
dumb son number one, dumb son number 1 through 1,000. They each get their cut.
And so their finances are actually deteriorating in this oil environment. Whereas, as we said before, Russia's finances are improving. Yeah. So they're playing the oil game reasonably well. In other words, they're taking advantage of good times in order to save up for eventual bad times. So I don't know. I feel some admiration for Russia financially, because they're the only ones who aren't screwing up. They're the only ones who seem to get that hard times will come based on current trends, and you should be prepared.
Yeah, well, it's going to be interesting to find out how smart they are, if they've outsmarted the world or not. It could very well be that they have, in which case, fine, then that's the way it goes. But I'll tell you this, just getting back to the gold and central banks accumulating it, I believe there was a kind of crazy guy, Cal Grunwald, and he said that all the cash for gold schemes were run by the Federal Reserve, and they were just buying up the gold, melting it down, and storing it. I don't necessarily believe that, but I think there's a better than even chance that every central bank in the world has been accumulating it, that we don't really know all the supply and the production metrics, even though the World Gold Council would like us to believe that they know everything. I don't think that we do. We have no idea, for instance, how much gold is illegally mined in South America, in Brazil. And you've seen the pictures of it in Guyana, in a lot of places that they just can't. These places where the real gold rushes are going on, John, they have no idea how much is being mined. I mean, these are guys that go dig up a couple acres of the Amazon, and then they take the gold and they put mercury in there, and they expose themselves to raw mercury, which is really bad because you get muriatic poisoning, which is where the term mad as a hatter comes from, because hatters used mercury in their production of hats in the 1800s and the 1700s. So, and they used it for clocks and stuff, for jewelry. So anyways, point is, the numbers are not precise. Nobody knows. It would not surprise me at all if, in fact, the central bank, the Federal Reserve, was accumulating gold all throughout the past 10 years and just forgot to tell anybody. Anyways, right? Would it surprise you? There's no transparency. I have no basis in fact to surmise that. It's just that these are people who this is their job. And they've been, if gold doesn't matter, why do we still have a gold reserve? Good question. Well, I was listening to somebody who said, the Chinese are going to tank the dollar later this year. They're going to blow apart the COMEX, and the real extent of their holdings are going to be known. It could be in the tens of thousands of tons, very possibly. On the other hand, it might not be anywhere near what you think, because the West might have been buying the stuff up all along, but pretending to sell. You just don't know, because there's no transparency. So you can't really form a definitive opinion other than to say U.S. Western banks dumb, China, Russia smart, therefore they've not done it. Well, I'm not convinced of that, John. We've done a lot of stupid things. You can't deny that. But certain things, I think, are a lot more, shall we say, difficult and less obvious than we think. Hey, there was another question here. Let's see if we can find it real quick. Okay. Well, Jesse again. Well, this one's a little tough, but I think we'll save this one for another day, because it's just a little bit too much. Here, I'm starting to see John's view on a global currency reset. Now, this is from Bill. And, but the thing is, he always says in terms of the US dollar being pegged to gold, yes, that's how it was. And yes, it's how it should be. But I don't think it's going to happen that way. John explains that if the dollar were pegged to gold at, say, 10,000 per ounce, then that will be the exchangeable for gold, which limits the supply of dollars, et cetera. He's not quite buying into that. So reset, yes, but how this reset is going to actually unfold, John, we just don't really know, do we?
Well, no, we don't know the details. The logical one would be a reset followed by some kind of a commodity-based currency going forward that limits the supply. And the gold standard worked for 200 years. So yes, it's the easiest thing to go back to, because we already have a historical precedent. But we do not know the details. We don't know how they're going to do it. They could do it really stupidly, which is to say, just do a massive devaluation with no other change, so they can start in again, borrowing huge amounts of money and running the debt levels back up again. That's the least painful for the government, but maybe not, because a massive inflation, which is to say a big cut in the purchasing power of your savings, isn't something you're going to put up with unless you get some kind of an assurance that it's not going to happen again, right? That would be the logical approach for voters. So the governments have to do something as part of the reset to guarantee that they're going to behave going forward, because they are going to get blamed for this. If bread goes to $10 a loaf and milk goes to $12 a gallon, you're not going to be happy about this, and you're going to want something in return for the pain that you're suffering. And one thing that you will probably want, and that you definitely deserve, is the guarantee that going forward, your currency is going to be managed well. So the question becomes, how do you do that? Gold standard is the logical choice, but there may be other ways of doing it. I love
the idea of it. Don't get me wrong. I will always be a proponent of it, not so much because I think that it's the be all and the end all, because it's not. The reason why is quite simple, because it's a constraint that they really just have to, it's just harder to defeat and work around it. It's a real limit, even though that they will lie and they will do what they can to subvert it. When you start from the beginning, and if you have a little transparency, it takes a lot of time to defeat that mechanism. And there's no other mechanism out there like it that can really stop it. Milton Friedman's was always, let's have a currency board, and it will create money, basically the rate of inflation plus the population growth. So if you have 1.5% inflation and 2% population growth, then you're looking at 3.5% rather, right? So,
Well, the problem with that, though, is that we can't define money accurately. So sometimes cash is the only money. Sometimes treasury bonds are money in a system, depending on the psychology of the market. So that's why that never got implemented. And in places where currency boards have been tried, where they always fail.
Yeah, always. Because
you can lie about how much money you're creating because the definition of money is unclear.
Correct. So I think we are going to leave it at that. Make sure you check out Jon's site, dollarcollapse.com. Sign up for his newsletter. Sign up for ours, financialsurvivalnetwork.com. Hey, we have had explosive increases in our YouTube viewership. Like 65,000 of you tagged on in the last 30 or 60 days. And so if you're on YouTube, please click that red subscribe button and share it and like it, and we'll like it too. And if you're listening on a podcast, just go and subscribe to whatever platform it is, iTunes or Spreaker, whatever, which one you're on. Just subscribe, like it, share it with a friend. Really helps get these ideas out. There's a lot of people talking about it, but nobody in the mainstream media, which makes us a very small percentage. But it's information that you need to have because you need to know what the heck is going on. And nobody out there is really telling you. Jon, till next week.
Thanks, Gary.
The Financial Survival Network. It's all about what's next.
Financial Survival Network is brought to you today by Oren Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Oren is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Oren's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Oren's been called one of the best in the junior exploration sector. Oren trades on the TSX and the NYSE under AUG. To learn more, go to orenresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's April Fool's Day. That's April 1st, 2019. Well, the biggest fool out there, at least at this point, is AOC, but we'll save her for another show. Right now, it's time for Mickey Fulp's monthly major market review, and the month we're reviewing is March 2019, last month. And Mickey, welcome back.
Thanks a lot, Kerry.
Hey, I should mention before we get into it, you can find Mickey's work over at mercenarygeologist.com. Mickey and I have been doing this now for we've been doing it for over 7 years. So this is our 8th year, and there's really no other review out there quite like this. Any questions or comments, just email me, kl@kerrylutz.com. So, Mickey, kind of slow month on Wall Street, up a little bit, but nothing resounding there.
Yeah, after the big run-up in the first couple of months of the year, the markets were up and down over the course of the month. There's some concern with overall world economy. Dow closed at 25,927 for a 0% change, but it still had the best quarter in 6 years at 11% gain Q1. It was flat. I think really it was affected by the debacle going on at Boeing. Meanwhile, S&P 500 and NASDAQ both had strong performances over the month. S&P 500, 2834, up almost 2% on the month, up 13% on the quarter, highest in 10 years. And the NASDAQ had a very good month, up 2.6%, closed at 7729. Gary, that's a 16.5% gain on the quarter. That's the best in 21 years.
Wow.
Meanwhile, I am concerned with small business in the U.S. Russell 2000, despite the rest of the markets doing quite well, lost 2.2% over the month, closed at 1540. But that said, it's still had a very good quarter, up 14% so far this year.
Yeah, pretty good. So let's
not bad.
Yeah,
not bad.
Yeah, impressive. And like you said, Boeing, that definitely brought down the Dow for sure.
Yeah,
probably a temporary issue. God forbid another one goes down, but probably they have the situation fixed. They found it was a sensor combined with a faulty software system that brought these planes down. So should be remedied shortly. So let's look at our foreign markets now.
Yeah, I'll make a comment on that. Let's put this into perspective. There are 1,000 people that die, more than 1,000 people a day that die in car wrecks in the U.S. And so this whole thing where a couple of planes go down is, I think that puts it into perspective. Anyway, enough editorializing on that. The Canucks are doing okay so far this year, despite a softening economy. They did not do well, as we both know, last year. Toronto Stock Exchange closed at 16,102, up 0.6% on the month, over 12% on the quarter. Nice gain. The Venture Exchange, the junior resource sector, had a very nice gain. So far in the first quarter, up 12.5%, closed at 627, up 3 points on a month. But realize we're still in a bear market. The days of the Toronto Venture Exchange at 3,500 or even 2,400 appear to be long gone, with the index sitting in the 600s.
In the doghouse.
Yeah. And the emerging market index was basically flat at 1058, up 7 points on a month, but it also turned in a very nice quarter, up 9.5%, despite slowing Chinese economy. The VIX came down toward the end of the month, finished below 14 at 13.72, but we did not see a lot of volatility through the course of the month.
No, that's for sure. So the VIX, it's been kind of getting more and more calm, more and more complacent. So let's take a look at our money stats here. The dollar, how do we do in the dollar?
Well, the dollar had a volatile month, but it ended up significantly, up to 97.2. It vacillated, say, between 96 and 97.5, seemingly on a every day or two basis. But that game was 1.1% on the quarter, 1.1% on the month. It really is the best of a bad lot, with a weak euro, weak German economy, this whole Brexit debacle, and that cloud hanging over not only the euro, but the British pound. I would submit that's why the dollar was up last couple of days of last week at the end of the month. Euro closed at 112. Down 1.1% on the month, over 2% on the quarter.
Huge.
Meanwhile, we mentioned a weaker economy, and certainly worldwide, and I think we're starting to see that a bit in the U.S. Pundits, economists are making a big deal that the yield curve inverted. It's now been inverted for something on the order of 7 days. If you look at the 3 months, Treasury bill interest rate, it's higher than the 10-year. This is generally thought to be a foreshadow of a recession coming, although those recessions usually happen 9 months to a year and a half out from the yield curve inverting. Really, this is caused by the Fed, in my opinion, Kerry. It must be bedlam over there. I have no idea what goes on at the Fed. And I mean bedlam as in the insane asylum at New York with a capital B, where the term bedlam came from. But my gosh, Powell gets up in December and says we're going to have 4 interest rate increases in 2019. And in mid-March, he comes out and starts talking about an interest rate rollback.
Just kidding.
In 2019. So here's
kidding.
to Stephen Moore if he gets nominated and elected to the Fed to a good economist who should bring some sanity to that group of entrenched New York and DC bankers and bureaucrats.
They're fighting him tooth and nail. They really don't want him there.
I know, Kerry. It does not look good for him.
They're saying, oh, you owe taxes, but he's overpaid his taxes. He accidentally deducted child support on his returns, and, which you're obviously not allowed to do even under the old tax rules. You are not allowed to do. So then they disallowed his deduction for alimony, which he definitely is entitled to. And from this, we have a scandal, Mickey. Anyway, there's Washington, D.C. games as usual, right?
He doesn't have a PhD from an Ivy League school in economy from Harvard or wherever. So that disqualifies
and he's a Trump supporter. Don't forget that.
Yeah.
So he's dead
he's
man
a supply side economist who tends toward the Austrian side. I know Stephen Moore from the New Orleans conference. I've shared the dais with him at times and seen him in the green room before we give our respective speeches. And, I kind of like what the guy says about the economy. He's a good guy as far as I know.
By all accounts, a good guy. And I've met him too a few freedom fests. He is a libertarian at heart, but, you got to be pragmatic. Right. Libertarianism is just not going to take the world by storm. Before we get into energy, Mickey, what about Bitcoin? It's coming back. It's over 4,000, right?
Well, it actually looks like it's bottomed, at least temporarily. I don't see it going to zero, as you've been predicting, anytime soon. It closed at 4,076, up 7% on the month and 10.5% on the quarter. And so that's 2 months in a row that Bitcoin's up. Here's kind of what I'm seeing. Wrongly, I think some people tend to flee to Bitcoin, much as they do to the U.S. dollar and gold as a safe haven. So when things get a little iffy, it seems like some people want to come in and buy Bitcoin.
Yeah, well, my theory is still the same. I still think it's going to break to 2,000. I don't believe it's bottomed out yet, but the market will tell us if we're right or wrong. Look, I was right about Bitcoin for the past almost 2 years, year and a half. I think I'm going to be right about it in the long run, but we'll just have to see. So let's go on to our metals, a rather lackluster performance all the way across the board here.
Well, yeah, it was not a particularly good month for the metals. Yeah, gold was up and down. Across the month, it went as high, I think, as 1330 or thereabouts, as low as 1290. And it was really dependent on two things. Interest rates. As interest rates went down, gold went up, as we would expect. But the other factor was the U.S. dollar. And we had this big rally in the dollar toward the end of that last week, and it knocked gold down $22 on Thursday. So anyway, it finished toward the low end of its current range at 1292, down 1.6% from 1311 on the month. Eked out a small gain. It's up less than 1% this year so far. Silver struggled to maintain at $15 ticker. I closed at 1509. It never got below 15 over the month. No one cares about silver except the silver bugs, and we'll leave it there. Platinum was stronger. It looks like it bottomed in the below 800 a couple of months ago, closed at 847. After platinum made a rally last month, it came off a bit for a 2.5% loss, but it does look like it's bottomed once it went below 800, closed up almost 7% on the quarter. And as we predicted, we didn't know when it was going to happen, but palladium went parabolic last week, and one day it went from 1585 to 1325. So, we said this was driven by pure speculation, although it's backed by strong fundamentals. Closed the month at 1364, down 10%, but it's still up 9% over the quarter. But Bloom's certainly come off that rose with futures tanking. What would it be? 3-month out futures are just tanked in June. So looks to me like this run is over.
Run's over, huh?
I think so. We'll see. And then copper closed down a couple of pennies, but still within its range at 294, down 2 cents on the month, but it's had a very nice quarter, 8% up. It really is dependent on trade tariff talks. So as the wind blows with news and rumor on that end, copper goes up. It can go up 3 or 4 or 5 cents and drop an equal amount over the course of a day.
Yeah, it's been pretty volatile lately, but the fact is the supply dynamics of copper over the long term, China is responsible for over half of its consumption, favors a higher copper price in the long run. But how long a run is really the question.
Well, Kerry, it really just depends on this trade tariff stuff. As soon as that happens, copper's gonna soar, basically because the supply-demand fundamentals are so compelling right now.
Yep, they certainly are that for sure. So let's move on to our energy, which was a good month for energy. Prices, at least for oil, the others not so good.
Well, oil had a very nice month. It's torn by a variety of competing geopolitical factors, but the demand remains very strong. We're now up over 100 million barrels a day. That would include oil and natural gas liquids, condensate et al. But oil closed at 60.18. for a 5% gain on the month, up a whopping 32% on the year, but realize it dropped 38% in Q4 of 2018. Yes. Brent followed suit, closed at 67.58, again up over 2% on the quarter and nearly 30%, 2% on the month and 30% on the quarter. Henry Hub dropped a dime as the heating season is ending and the northeast tier of states closed at 271, down 3.5% on the month, down almost 8% on the quarter. Kerry, there's just too much supply of gas in the U.S. And, so here's my solution. Everybody drilling shale wells in the Permian Basin needs to go on a regimen of Beano.
Well, that might just do the trick, but there's so many shut-in wells, Mickey. Like, what are we going to do? There's thousands of shut-in wells.
Those are called ducks for the most part. Drilled and uncompleted. But the problem is when you produce oil in any of these shale basins, you're going to get gas to go along with it. So it is what it is. U.S. oil market continues. Production is at an all-time record of 12.1 million barrels a day. Rigs have come off significantly, drill rigs over the last couple of weeks. But, if we can find a way to get this oil to market, that's the real problem right now. Enough pipelines. And meanwhile, uranium had a very bad month. It broke down from that 29 plus or minus level, closed below $25, 24.88, down 10% on the quarter, 13% on the year. And my sources tell me one of the reasons this is happening is that Cameco has not bought any uranium on the spot market this year. And they have 11 to 12 million pounds of unfilled contracts. So it looks to me like they were trying to arbitrage by not buying uranium when they have to buy it at some point for deliveries in 2019. Arbitrage that price and come in and buy it when it's low and sell it into their higher contracts. We'll see if that plays out, and we will see in the next couple of weeks the Section 232 national security domestic uranium mining issue is scheduled to be ruled on by the Department of Commerce, and everybody expects that to be positive for domestic uranium mining companies.
So we import 98% of our country's uranium needs from other countries. So I guess they want to see that change.
Well, and especially want to see that change because 40% of those imports come from Russia, Kazakhstan, and Uzbekistan, three countries that I would not say are friendly, stable, or above board with their governments.
Yeah, definitely not. So sooner we get production back in the U.S., the better. I just wonder what's going to happen with the properties that went to Uranium One, whether they're going to be expropriated or condemned or whatever, but something's going to happen.
Well, that's in terms of annual production, it is significant. When the U.S. uranium producers are economic, it amounted, and the deal was done, amounted to about 1/5 of domestic production, somewhere around 1 million pounds a year in the Powder River Basin of Wyoming. But it really is of concern that we would have the Russians controlling 1/5 of our uranium production.
Yeah, not a bright move. So let's just move to our ratios and the ones of note, the gold to silver ratio back up.
Well, above 80 for the 8th month in a row, and it's actually finished the month at 85.6. This is pretty rare territory, as we've talked before, and silver just can't get a bid right now, and that's the main reason. If the price of gold starts going up, we would expect silver, given this ratio, to perform much better, as it always does in terms of volatility, either on the upside or downside. And finally, the other ratio would be platinum and palladium. We wanted to mention that this month because it recovered off its all-time low. It actually hit 0.57 intra-month, but it made a nice recovery as the palladium price came off much faster than the platinum price did.
Yeah, very true. Well, that is it for March 2019. Mickey, we'll just have to see how these trends continue into April, because we're getting pretty close to May, at which time it's certainly been true for a number of years. Best thing to do is sell and go away in May, right?
Well, that's the Wall Street maxim, if you will, sell in May and go away for the summer. Some months that works, some years that works, and some years it doesn't. It's not something that I pay much attention to. When profits are there to be taken, you can never go wrong by taking profits in the stock market, Gary.
That's for sure. And just because something has happened before does not automatically mean it's going to happen again and again and again. It's a nice maxim, but it really isn't a substitute for critical thought. Anyway, go check out Mickey's work at mercenarygeologist.com, Twitter feed at mercenarygeo. Check us out as well, Financial Survival Network, and Twitter feed at Kerry Lutz. Mickey, we will catch up with you again next month.
Yeah, Kerry, we will. And I want to give a shout out to our friends at Kitco. They now are posting this interview, and it'll be up in Kitco as an alternative way to look at it or listen to it, pardon me, for about the next week. And we appreciate those guys.
Yes, we do. Hats off to Kitco. Mickey, we'll talk to you next month.
All right. Thanks a lot, Kerry.
The Financial Survival Network. It's all about what's next.
Financial Survival Network is brought to you today by Oren Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Oren is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Oren's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Oren's been called one of the best in the junior exploration sector. Oren trades on the TSX and the NYSE under AUG. To learn more, go to orenresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's April Fool's Day 2019. Hey, did you hear that one? The economy is firing on all cylinders. It's doing great, better than ever before. Oh, wait. They were saying that before April Fool's Day. But the march to socialism continues. AOC is on her uninformed, ignorant, ill-advised mission to make socialism great once again. But you can't make something great that was never great in the first place, that has been the ultimate wealth destroyer and civilization destroyer throughout history. Hey, well, as always, you got a view on this, you want to get involved, email us, kl@kerrylutz.com. So someone we haven't had on in a while, Dr. William H. Northwall. Dr. Northwall, you're political expert, conservative analyst, and author of Return to Capitalism. Welcome back to the show. And so what about the emerging socialist left? The people who think they know how to fix whatever ails society, just take everything over and let the government run it. Is that a prescription for prosperity?
Absolutely not. I've written a book on capitalism, thinking, maybe it could change a few minds. This socialistic idea sweeping the country, and so many of the Democrats are aligned with it. It's very dangerous. It just is a very wasteful, inefficient way to run a country, with government planning what used to be planned by each individual for the individuals to vote for socialistic politicians that are going to do all, why worry about how I'm going to get my health care? Let's let government take care of it. Well, it's a very wasteful thing that ends up with a lot of debt, and debt eventually destroys the country. And nobody seems to be worried about this. So that's why I want to speak forcefully on the subject. Socialism just leads to no good ends. I mean, you can look at Venezuela, but, think back on Germany in the 30s being the most socialistic country on the face of the earth, and what that led to. Socialism always leads to tyranny and then downfall of governments. And so why, when we have a system that's been working wonderfully in the United States, lifting prosperity for everybody, why do we want to destroy this system through debt and inefficiency? And so right now, the one party is advocating Medicare for all. They're not even talking about expanding on Obamacare, which has been a disaster. But, they start with Medicare and Medicaid, and over the years, you think, well, this is sort of normal, and maybe it would solve the increasing cost to health care by having more government. Well, more government just raises prices because a central planning committee, which is what socialism is all about, they are going to make economic decisions, a one-size-fits-all plan that's going to take care of 300 million Americans. Come on now. Each individual in the past had to make these decisions on their own, what they needed and within limits of what they could afford. Now, affordability, to heck with it. Let's just let government take care of it. But this is just going to lead to disaster where nobody's going to be happy. So that's how I start off with that, Kerry.
Yeah, so socialism's been tried a lot of times. It's never worked, right? There's never been a recorded incidence throughout history where socialism actually left people better off than you were before, correct?
Oh, absolutely. And, that Venezuela thing is such a bizarre story because I believe it was around 1950, they were the fourth wealthiest country on the face of the earth. That's behind the United States, I think, is one of the Scandinavian countries, Norway, I believe, and I think New Zealand were the first three, and then Venezuela. They have the world's largest oil deposits. And to think that today that country is in turmoil with people starving, not having food, not having water, potable water, and to think this couldn't happen here, of course it will happen here if we turn so many of our economic functions over to government with the idea government's going to take care of us. Only individuals can take care of themselves. Government can't take care of us. It just won't work.
Yeah, very, very true. So, but how do you defeat these bad ideas, which are obviously bad ideas? How do you finally put socialism to rest, put it in its richly deserved deathbed?
Yeah, well, that's the big question for today. And not that I can answer it or you can answer it, but ideas have to be fought with opposing ideas. It needs debate, and there's very little popularity and very small numbers of people that are speaking up against this socialistic thing. It's being embraced by more and more of the Democratic contenders for president, and of course, people running for Congress and the House of Representatives. They sort of follow the lead of the contenders for presidency. This has to be counterbalanced by opposing viewpoints with good ideas and ideas that make sense. The political debate has to be carried out, but I think our national news media has sort of failed to represent a balanced approach, giving views of both sides. It seems like the national news media and where people get their information now more and more off the internet are only getting one side views of economic future under socialism or capitalism. So I don't know. It's a little discouraging, but people have to continue speaking out, such as yourself and others like you. And I don't know how else to combat this. What do you think, Kerry?
Yeah, well, I'd love to think that rationality and information is going to save the day, and it's really going to happen. But I've seen too much in the past couple of decades to think that. I think it's a war, and it's a war of ideas, of which socialism has no new ideas, and it's got to be defeated once and for all. But when half the Republican Party are just socialists, Democrats, rhinos, whatever you want to call them, I think it's very difficult to get that through. There's really nobody who's really fighting for Western civilization here. Nobody's fighting for it.
Yeah, I have to give the president high marks. Just about a week ago, he gets out of this. The Mueller report is finalized and sort of takes a burden off the president, and he decides to pivot, if you will, take up a new issue, and he comes back and says, hey, let's make the Republican Party the party of health care. And then some of the leaders on the Republican side in the Senate said, oh, we don't want to bother going back. That's sort of a settled issue. Well, this is a biggie. Healthcare is, maybe 20% of the economy right now. It's a huge amount of resources money, people involved. It's just a huge, huge thing. And the idea that, let's say, the 180 million Americans that receive their health care through the private insurance industry, which they paid for, are going to all of a sudden give this up and let the government just take over, and maybe they'll supply what these people need. Maybe they won't, but I don't think these people, 180 million that have their insurance from private on the private side, are going to give it up very easily.
Right.
So it's a big deal.
Yes, it certainly is. And, like I say, I think we've been losing this war because it hasn't really been perceived as a war, and nobody has really gone after it and said, this is a war for Western civilization, and we need to fight it as such. And that's what I find disturbing, because, look, there's a lot of inequities, a lot of bad things in capitalism. It's not a pretty thing, but it's like Winston Churchill said, Doctor, democracy is the worst system in the world except for all the others. And you know what? The same thing applies to capitalism. It's the worst economic system in the world except for all the others. And we know this. And what we have in the U.S. is some kind of hybrid between socialism and capitalism. It's a transitioning system, I guess. And we need to do something about it, because otherwise there's not going to be a system that can be saved.
Yeah, if I have a minute left, just briefly, there's a lot of confusion over what capitalism is. People think, well, that was Henry Ford, or today it's Bill Gates. Capitalism is anybody, a shop owner, a doctor, a lawyer, anybody who creates a little business and earns some money from it, and then takes his money and reinvests it in his business and makes more money. But I think what's confusing is, let's say out of 100 workers, maybe, or 100 people, there's one or two business owners, and all the rest are workers that work for such small or medium, large businesses. The workers benefit also because they have more jobs available to them in a capitalistic system, so there's more choice to move around to jobs they like best and to compete, find more money, higher salary. So capitalism isn't for greedy rich people stealing from the masses. Capitalism benefits everybody, and government-run things outside of which you just have to have a civil society. Everything else is just up for waste and corruption and graft and inefficiency and just running up debt. So
yeah, I know that. I know that, and you know that. But AOC doesn't know it, and half the millennials, more than half, don't know it. So it's not just enough to say that. You have to do something else, right?
Well, a 29-year-old is just getting started, and I have to say she's attractive to look at and sort of fun to watch on television, and she's got quite a following, but she's got a lot to learn. Did they say she was an economics major?
Yeah, hard to believe.
That.
Hard to believe. Yeah, I can't either. I really can't believe it either, but that's the case. Well, anyway, so your book, where do we find it, Dr. Northam?
Well, it's on Amazon. It's on Barnes & Noble. Go to either William Northwall and under books, and it'll come up, or Return to Capitalism, the title. Put that into Amazon or Barnes & Noble. It'll come up. It's about $20. And I'm on the second edition. I'm now planning for a third edition to sort of clean up a few things, modernize it a little.
All right, excellent.
And go to my website, www.williamnorthwall.com, and it'll tell you about my book and some ideas.
Okay, excellent, Dr. Northwall. Appreciate you coming on. A Questions, comments for myself or the good doctor, KL@KerryLutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Doctor, thank you so much. We'll talk to you again soon.
Thanks for having me, Kerry.
The Financial Survival Network. It's all about what's next.
Today's show is brought to you by Blue Sky Uranium Corporation. Blue Sky has first mover advantage in Argentina in the world's newest uranium and vanadium district. With an existing near-surface deposit that's open for expansion, Blue Sky also controls a massive district-scale land package with mineralization along a 145-kilometer-long trend. Blue Sky possesses tremendous exploration upside and is an excellent leveraged play on rising uranium and vanadium prices. The company is run by a best-in-class management and technical team with proven exploration and development success in Argentina. Blue Sky Uranium trades under the ticker symbol BSK on the Toronto Venture Exchange and as BKUCF on the OTC. For more information and to stay on top of the latest news, go to blueskyuranium.com. That's blueskyuranium.com.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's April 2nd, 2019. Well, you're always looking for a market edge. You're always looking for a way to try to predict or get away from the trend or get to the trend before it happens. Imagine being able to see next month's financial results in a newspaper today. Well, we can't do quite that well, of course. That would be a kind of back to the future type endeavor that we're just not capable of now. Probably everyone would be doing it, and there would go your ability to profit. The fact that not everybody can do it is what makes it profitable, potentially profitable for you. Well, anyway, as always, email us with any questions, comments, and be a part of the show, KL@KerryLutz.com. And so right now, got somebody who's a ace forecaster, market timer, has been acknowledged as so. His name is Steve Rhodes. Steve, you are author of Mastering Probability, which is a daily newsletter service, and it's all about timing, right? Like everything else in life.
Absolutely.
Yeah. So how do we do it? How do we become market timers, effective market timers? To some extent, everybody is a market timer, but usually not a very good one.
The question, how do you do it? I think I can tell you the way that I did it. And the way that I did it was simply, I immersed myself in different sets of tools. I took the works that other folks did and found ways to make them better. And what I mean by that, Kerry, was that certain tools which would identify where a market should turn, they wouldn't turn there. And I went back and said, well, what is it that maybe was missing? And so I found some of those missing ingredients. And specifically, one of the things that I utilize at the completion of different patterns, because I'm a pattern recognition individual, master expert, or what have you, I'm always looking for the market to communicate to me when that pattern is complete. And the way that it does that is it generates either a bullish or bearish reversal candle. So I'm referring to Japanese candlesticks, but I don't use Japanese candlesticks in the middle of moves out there. I only look for these candlesticks to occur at the completion of a certain pattern that my system looks for. And that's one of the ways to allow the market to communicate to us when the turn may or should be occurring out there.
Mm-hmm.
As an example, right now, what's present for today and what I'm watching for is the Dow equity futures. And that's where my focus is, because I believe that's where the next message comes to us, because the Dow has in effect been in the Dow equity futures, and you can see the pattern there more easily than you can in the cash indices. And it's been in about 1,000-point consolidation that began February 13th. And it's right now at the top of that consolidation. So we're either going to see a breakout, and that would mean a close above 26,280. The Dow equity futures close above 26,280 and then stays above that level. We should see a move to 27,380, give or take. Mm-hmm. Likewise, we're at the top of this consolidation. It's very possible that the extent of the rally ends right here. Now, when I say ends right here, it just stays within this consolidation, and we then see a move back to the 25,260 level, this 25,280 level out there. And if there's a break to the downside, then we're looking at 24,229. And consolidations are easy patterns to identify and spot. So for me right now, as we speak, it's all about the Dow to give us the next signal.
Okay, so it could be over, it could go further. What about longer term? You mentioned pre-call that there's a certain indicator, if you will, that every time you see it sends shivers up your spine because it always predicts a recession, a down market.
It not so much a recession, but it's a pattern that's been present since 1896 before every bear market. And when I say bear market, I'm just using the standard terminology of a 20% decline or more, not necessarily end of a bull market, but just simply some type of correction. And that pattern was in place back when the Dow, the S&P were making their highs, and the Dow specifically back in the October 3rd, October 4th timeframe. And that pattern was present on a daily timeframe, a weekly timeframe, and a monthly timeframe. And that, in fact, led to a 20% decline, going back into 20% or more decline into those lows on December the 24th and 26th out there. That pattern is not present right now, but it could form as price moves higher. I just have to wait for that to unfold. But right now, my signals say, watch this 26,280 Dow equity futures. If we get a close above that and price stays above that level, expect a run to the 27,280-ish type mark out there.
So what about the economy in general here? Any particular insights you have that can help you to understand better where we're at in this cycle?
I think that one of the things that's talked about a lot right now is the inverted yield curve. And for me, I think you have to go study what's going on inside the Treasury market and pay attention to how they're moving in terms of euros, yen, and pounds, the major reserve currencies of the world out there. And I think what we're seeing here, or at least what my data shows, is that the Treasury market we're seeing a rush of capital coming out of Europe into the U.S. And so I don't think that the inversion that we've seen is a signal that we're going to see a recession inside the United States. I think it's just as important to understand the flow of capital from around the world, because if you track instruments, you'll see that when gold has a sustained rally, as an example, you will see it moving higher in all major currencies, because we're in a one world market. And so traders in their local currencies need to see an asset rising. And if so, they'll continue to invest in it, momentum traders and so forth. The same thing holds true for bonds out there and any instrument in the Dow. In fact, the Dow, as an example, made a new all-time high priced in euros yesterday. And that suggests to me that we will eventually get back to the all-time highs and likely exceed them as well.
Yeah, well, that's kind of my gut feel, too, for other reasons. So do you look at any fundamentals at all, or is it just, technical?
It's a great question. It's a great question. So a little bit about my background. I'm a CPA, so I'm a licensed CPA. I don't practice that, but so you say fundamental. I've been a CPA since 1980. And so I used to fundamentally analyze every stock holding in my portfolio. At one time, 100 individual stocks. And I would go through all of the SEC filing requirements and take a look at the balance sheets and the cash flow and read the MD&As. And what I learned was that the most fundamental aspect of trading and investing was understanding what shareholders were doing. And by reading all that documentation, it wasn't telling me the most fundamental thing about my investments. And that's really what led me to what people refer to now as technical analysis. But for me, technical analysis and taking a look at a stock chart and using the set of tools that I use helps me understand what buyers and sellers are doing. And to me, that's really what it's all about. more than anything else.
Yeah. So it's sentiment, it's flow of funds, I guess, have an important bearing on this as well.
Yeah, the global flow of capital, the flow of funds is really important. When I started taking a look at different instruments, take for example Bitcoin. When I started looking at Bitcoin and pricing all of these currencies, you could see it all moving up at the same time. So you could see these traders around the globe, each person in their local currency was moving higher. Of course, it was going to continue to move higher. And then you can watch it fall off the cliff. And it was doing so in all of the currencies. And so the same thing. So, when I take a look at the Dow making a new all-time high price in euros yesterday, if you go back historically and take a look at the Dow price in both dollars and euros, I look at it in yen and pounds as well. But just to make it simplified here, just look at it in euros, you will see that a top inside the Dow price in dollars does not top out in euros first. They're both going to be at new all-time highs at the same time before the next type of a top comes in. So yesterday was a very promising longer-term element about where the Dow is, in price in dollars is eventually headed because of that new all-time high in euros.
Interesting. So it tells you that there's money coming from Europe. Is that what it's telling you, or
yes, absolutely. It's coming from Europe, and when you start looking at these charts side by side of these instruments, major instruments priced in these major currencies out here, all of a sudden it's this light bulb that goes on, and of course it makes sense. It made all the sense in the world. Of course, our brothers and sisters, so to speak, over in Japan or over in London or over in anywhere in Europe, they're always taking a look at their instruments priced in their currency and instruments. And so, for example, most people don't realize this, as great of a return off of the 2009 lows that we've had in our markets, it's nothing compared to if you were a euro trader. A euro trader in the Dow since the 2009 bottom has outperformed the Dow priced in dollars. And the same holds true for yen. The same holds true for pounds out there. So looking at instruments priced in these major currencies is really important. That's a fundamental thing to look at.
I can totally understand that. And so do you follow commodities or any other markets that are noteworthy?
I do. I certainly follow the gold market and in commodities in general, because I'm looking for commodities in general to form some type of solid bottom as the next, as one of the next great longer term investments. But I'm always tracking gold and the miners out there, but coffee, other commodities, sure. I follow those.
Yeah. So what about metals? What are you seeing there?
So in metals, specifically right now, we're sitting here at a key level of support, which specifically is, in essence, where we're trading right now, about $12.94. And if gold's able to hold this, then we continue to make these higher bottoms. So just a simple thing out here that it appears that gold made a important bottom back in 2016, and we continue to make these higher lows. And if gold can hold this 1292 level, then we should see another run back to the most recent high. So, and the reason why I take a look at what's going on in gold, and I look at that in all the currencies as well, is the best way to play it. If gold is forming some type of bottom, the mining equities outperform anywhere between 2 to 5 to 1. So when folks are trading gold and they spot some type of tradable bottom, they really should also be looking at really making an investment inside the mining sector. Because if it's a bottom, the correlation between the two, the mining sector itself is going to outperform.
Interesting. So you think we're going to see some movement on that front, huh?
It's the pullback out here that we've seen since I'm just talking about now over the last week and a half, has been simply a pullback to support. So if gold's able to, I would say that as long as gold doesn't close below 1288.30, then this uptrend continues. If it does go below that level, 1288.30, then we're looking at a move. I was going to try to do this here. I can't do it on the fly.
Yeah.
But I would say it would be a move equal to 1356 minus about another 100-point move, 100-point move lower.
100-point move lower, yeah, if it breaks.
Yeah, if it breaks.
Sure. So 1280, that's the magic number, eh?
My magic number, 1288, but you got to give it a few bucks.
Yeah, sure. Nothing is perfect, right? So, yeah, so interesting. Any other markets you see that are flashing signals, Steve, that we should know about?
I guess at this stage here, what I'm watching for, because we're in this longer term consolidation market, and until we break it, it always means that if you can't bust out the top of the consolidation, you can go down to the bottom. So we were taking a look at a shorter term time frame for the Dow. There's a longer term consolidation inside of the Dow as well. And so, therefore, I'm watching the other markets. What's the S&P 500 doing? What's the NASDAQ doing? All of the markets, all of the main stock markets here in the U.S. And so I have some key levels that I am observing inside of the ES Mini as an example, to track the S&P 500. And to give you an idea for the levels there that folks should be watching, the longer-term levels are 2885. That's really, I'm looking at that from a quarterly basis. In other words, if the ES Mini closes above that, we're at least going to go test the all-time high, and more likely we're going to get up to about 3,100 would be the price target. The other level, the other confirming level I'm looking at is 2892. These are levels that should hold as resistance. So again, that range 2892 to 2885. If the ES Mini closes above that, that tells me that it's ready to make its move back to its all-time high, and then a little bit beyond that as well. Otherwise, that's significant resistance up here. So we're really getting close to an area where the market's going to communicate to us its next move.
Okay, so we're a little uncertain now, but your gut feel is it's going to go higher.
Longer term, yes. The key, and it's really, the Dow is kind of like the trophy horse, so to speak.
Right.
And so I'm really watching that trophy to see where that next piece of information comes from. So shorter term, we're watching a shorter term consolidation, and longer term, it's really the highs of 2018, but really beyond that, just that you can draw a little trend line. You have to give things a little bit of room out here. So even if the Dow takes out its all-time highs, it's still going to need to do so. It's going to need to be probably a 500-point move beyond the highs, the all-time highs, before it gives us any signal of an ultimate breakout. But if the global flow of capital continues to move towards the U.S., and there's no reason to think that it won't at this stage of the game, that's the put. People talk about the Powell put. The real put is the Euro put out here, where people are just simply trying to get their money out of Europe and into the U.S. So we've got a strong U.S. dollar. That's up another 246 ticks this morning. You got the dollar higher. You got bonds higher. That just tells you and I that capital is fleeing Europe and coming here to the U.S., or at least that's what it tells me. Right.
Gotcha. Interesting. So,
and that's kind of the fundamental aspect of what, and when you ask me a question, is there anything fundamentally that I look at? I think that understanding where, the old Jerry Maguire, show me the money.
Yeah.
To me, that's the fundamental element of it, right?
Yeah. Hey, well, look, we can talk all we like, but until you perform, which you have in the past, you've gotten some awards too, haven't you?
Yeah, I was named the 2018 Market Timer of the Year by the folks at Timer Digest, and was number one market timer for the S&P 500 and for bonds, and they also track gold. And I have been number one there, but when the end of the year, I was number 5 market timer for gold. And so what's really great is just I utilize these tools, and I utilize them for all time frames. A chart, I'm agnostic to time. It's just really the chart patterns. And so this set of tools that I use works for whether you're trading a 30-minute chart and trading the equity futures, or maybe you're just trading treasury futures, whatever it is that you might trade. And the reason why I mentioned futures is because as a technician, for me, I want to gather as much information as I can. So it's much easier to do that for the patterns that I trade versus the cash markets.
Mm-hmm. Mm-hmm. So you've got a lot of monitors on your desk, don't you?
I do have a bunch of monitors.
Yeah, you can't have enough. You have to get one of those 49-inch curved monitors where you can put everything up there.
Yeah, but you got to have just the right amount of information because you don't want to be able to. You don't want to have overload.
You don't want information overload.
Stop you from because it is really all about having confidence, knowing your system expectancy, and setting up to take the trade. How many times, each of us when we go shopping, we love buying things on discount. We don't hesitate, when that pair of pants or shoes or what have you is on sale. Yeah. But when the stock markets start getting on sale, it's nice to be able to have a signal. And so it's nice to be able to utilize these tools to be big from an emotion standpoint, but just utilize these tools to see the emotion of the market change. And that's really what I do. And then you just have to have the confidence to go ahead and pull the trigger, so to speak. But always use stocks about managing money. Mm-hmm.
So, hey, when you're not busy forecasting markets, what do you like to do?
I love to golf.
Okay.
I love to golf. I live on the water. So I live in South Florida. I live in Delray Beach, Florida. And I'm very fortunate. I've got the intercoastal on my backyard. Sure. So fishing or golf or doing something outdoors, that's the walking on the beach. That's a great way just to chill out, so to speak.
Yeah, well, I'm only about 35 miles north of you, so I know exactly what you're talking about. And outdoor living, although outdoor living is a little tough in the summers, a little hot, a little sticky, but the rest of the year, it's heaven on earth. Hey, just tell us again, Steve, where's the website? Where do we find you?
So masteringprobability.com. I provide folks with a free 30-day unconditional money-back guarantee trial of the newsletter. It contains a lot of education, so I have maybe 4 or 5 different archived 1-hour archive workshops that allow individuals to really get a sense of the tools that I use. And again, masteringprobability.com.
All right. Masteringprobability.com. It sounds like a fascinating site. I like the fact you've got a holistic theory that goes cross markets. Some people say, well, this theory will only work on the Russell 2000 stocks or only on the Dow transports or the utilities. Yours crosses markets. It crosses different, whether it's gold or currency, or I guess oil too. You can oil come
too.
up.
Absolutely.
Yeah. So I like that it crosses disciplines, multidiscipline theory. It's a great thing. Hey, questions or comments for Steve Rhodes or myself, email us, kl@kerrylutz.com, Twitter @KerryLutz, and Facebook Financial Survival Network. If you are listening on a podcast or you are listening on YouTube, and that probably encompasses all of you out there, then please subscribe on that platform, like it, and share it with your friends so information like that you just heard from Steve can get out there wider to people who really need it. Steve, it's been an absolute pleasure. We'll talk to you again real soon. Thank you so much.
Sounds great. Thanks for your time. Have a great day.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.